All right, in this explainer, we are going to break down the essential financial ratios every single investor should know. And we're going to uncover how one key metric, return on invested capital, or ROIC, can reveal the true quality of a business. So let's dive right in.
You know, it's the million-dollar question, isn't it? How do you find those truly exceptional businesses that are just hiding in plain sight? It might seem impossibly complex, but what if I told you there's a way to look right under the hood and check a company's financial health?
Well, the secret is all about understanding its vital signs. Just like a doctor checks your heart rate and your blood pressure, investors use fundamental ratios. These are awesome tools that take all the complex, messy numbers from a financial statement and translate them into simple, powerful indicators of how a company is really doing. So, let's open up our Investors Toolkit. The very first set of tools we're going to look at are all about profitability. I mean, at the end of the day, a company has to make money, right? These ratios tell us just how good they are at it.
Okay, so we look at profitability in 3 layers. First up, you've got gross margin. This tells you how much profit is left right after paying for the direct costs of making a product. A high gross margin, that's a great sign of pricing power. Then we dig a little deeper with operating margin. This shows the profit from the core business itself. It's a fantastic indicator of how competitive a company is for the long haul. And finally, net margin. This is the bottom line, what's left after every single expense is paid. This is the pure profit that investors like us ultimately care about.
All right, so a company can be profitable. That's great. But is it efficient? That's a whole other question, right? How well does it actually use its resources to make those sales? Let's grab our next set of tools and find out. First up is asset turnover. Think of a company's assets, its factories, equipment, cash, as its engine. This ratio tells you how much sales horsepower it gets from that engine. The higher the number, the better. It means the company is really squeezing more value out of everything it owns. Next is inventory turnover, and this one is super intuitive. It just measures how fast a company can sell the stuff that's sitting in its warehouse. A high turnover is fantastic. It signals strong demand for their products. But a low turnover? Oof. That could be a huge warning sign that sales are slowing down, or maybe even that management isn't on top of things.
Okay, let's move on to 2 areas that are, honestly, absolutely crucial. First, how safe is the business from a financial perspective? And second, how does the stock market actually think about it? What's its valuation? Let's take a look. A really crucial safety check is figuring out how a company is funded. The debt-to-equity ratio shows us this exact balance. Is it relying more on borrowed money or on money from its shareholders? Now, a little bit of debt can be a useful tool, but way too much of it? That just ramps up the risk, especially when the economy hits a rough patch.
The most basic safety check of all is just this. Can the company pay its bills over the next year? The current ratio gives us that answer, plain and simple. It compares what a company owns that's easily turned into cash with what it owes in the short term. Generally, a ratio over 1 is a healthy sign that it can cover its immediate debts.
And now for valuation, let's talk about the famous P/E ratio. It tells you how much investors are willing to pay today for every dollar of a company's earnings. But here's the thing you got to remember. A high P/E isn't automatically good or bad. It could mean the market expects huge growth, or it could just mean the stock is way overpriced. With the P/E ratio, context is everything.
Okay, so we've looked at profitability, we've looked at efficiency, and we've looked at safety. But now let's talk about the metric that ties it all together. The true star of the show for finding a high-quality business, return on invested capital, or ROIC.
At its core, ROIC answers this one simple but incredibly powerful question. It measures how effectively a company uses all the money invested in it, whether from lenders or shareholders, to generate actual, real profit. It's the ultimate measure of how good a company is at turning capital into cash.
So why does this matter so much? Well, it's because companies with a consistently high ROIC tend to crush the market over the long run. A high ROIC is the clearest signal you can get that a company has a durable competitive advantage, what the legendary investor Warren Buffett famously calls a moat that protects its profits from competitors.
So what does a good ROIC actually look like? Well, anything below 5% is pretty weak. You're not getting much bang for your buck there. Once you get over 10%, you're in generally good territory. But when you start seeing numbers consistently in the 15% to 20% range, or even higher, now you're likely looking at an excellent company, a true industry dominator.
Let's make this crystal clear. Imagine 2 companies, and both of them invest $100 million. Company A goes out and generates $20 million in profit, giving it a fantastic 20% ROIC. Company B, using the exact same amount of money, only generates $5 million in profit. That's a weak 5% ROIC. See the difference? Both are profitable, but Company A is a far, far superior business. It's just a value-creating machine.
Okay, we've covered a lot of ground here. Now remember, no single ratio ever tells the whole story. The real power comes when you start to see how they all connect, how they form a complete picture of a company's health.
Think of these ratios as puzzle pieces. Together, they help us answer the most critical questions you can ask. How profitable is it? Really? How efficient is it with its assets? How safe is its financial structure? How is the market valuing it right now? And most importantly, does it create real, durable value for its investors? The answer to that last question, more often than not, is found in its ROIC.
By mastering these concepts, especially ROIC, you really gain the ability to look past all the noise and the hype and analyze a company with real confidence. Smart investing isn't about guesswork. It really does start with understanding the numbers.
And that brings us to the end. So I'll leave you with a question to chew on. Based on what you've just learned, which company that you follow do you think has the highest ROIC? Go look it up. The answer might just surprise you.